Good afternoon and welcome to today's webinar hosted by the National Network of Credit and Financial Professionals. I am here today with Ryan Sanowski and Sid Vidya from Wells Fargo, who will be presenting on Demystifying Banking Treasury Management. A few items to get out of the way before we begin. If you have any questions during the course of the presentation, you can ask them through the questions function on your side panel. We will gather all those questions and save them for a question and answer at the end of the presentation. If you are looking for a copy of the slides to follow along today, they are available through the handout section in your side panel. We will also be sending a copy through email after the presentation is complete. The last item is that we will have a brief survey that pops up after the webinar ends. It only takes about 30 seconds to fill out, but it gives us a lot of great information on how we can continue to make our webinars better for you. Now, Ken Frisco will give you a brief intro of our speakers.
Okay, thanks, Sharon. Just a brief background on our speakers today. Sid is a business development officer with Wells Fargo, servicing the 83 lines of businesses for the bank, with especially in working with businesses with revenues of $5 million to $500 million. Sid works closely with clients to understand their business concerns such as growth or efficiencies and creates a strategy to help them. Our other speaker, Ryan Sanowski, is a business development professional specializing in bringing people together and providing treasury management consulting to his business clients. Ryan holds a master's degree in business administration from Centenary University in Hackettstown, New Jersey, and he is an active volunteer for the New Jersey Sharing Network. I'd now like to turn it back to Ryan to begin the presentation.
Thank you, Ken, and thank you for everybody for joining us today. I wanted to kick this off and speak a little bit about treasury management holistically and really dig into what the reason that exists and why is it important for your day-to-day functionality as you manage your companies. Treasury management. So I like to say whenever I speak with a client or a prospect or anybody that asks me, what do? I like to indicate what treasury management is, and this is the way I say it. A financial heartbeat your company depends on to run your business day to day. Now, how else could I say that? That can also be said in a way where it's how you manage the operations around accounts payables, accounts receivables, and managing the risk factors that any company would endure on a day-to-day. All that falls under treasury management. An additional piece to that, which we covered later on in the presentation, involves financing. Now let's get into that a little later on in the presentation. So an interesting stat here. There was a study done by Deloitte in 2015 indicating that 90% of CFOs say that treasury management is important for their companies to be successful, right? And they look at treasury management professionals as a strategic advisor so that they know how to position their company to be the most efficient to achieve their goals. At the end of the day, most, if not all, organizations have a strategy to execute through any given year. And in order to execute on that strategy, you got to have some goals. You know, what are some of those goals? An example would that be managing liquidity and working capital, controlling those costs, and driving payment process efficiencies. You can't leave receivables out of that either. So it's not just payments. And then also, of course, reducing business risks. So some of the strategy around why you want to manage liquidity for your organization is so that you can maintain that mobility. If you were to decide on, I need to buy this product because I have an opportunity to get it at a great price. If you don't have liquid capital available to pay for that, you're missing out on an opportunity. It could be an opportunity to grow your company or maintain the size of the company or whatever the next steps in your plans could be as you manage. Controlling the cost is on the other side of that conversation. Now, we hear about it all the time in the news and companies shrinking down, creating efficiencies. There's a reason. So as the costs continue to increase, you have to be very strategic in where you place your funds, what you're paying for with the capital that you have. So managing a payment process and managing a receivable process closer, where if on the payable side, you have the ability to take advantage of discounts by paying earlier or extending those payments out long enough where you maintain the cash on the books for a longer period of time, creating that mobility. On the flip side, for receivables, generally speaking, you want the money to come in as fast as possible. So you maintain that cash on your balance sheet longer. The other part of that is managing risk. And I'm sure we're all in tune with what occurs in the news, whether there's a massive breach at a credit reporting agency or a retail company through, say, merchant transactions, or personally, if you've had your credit card information or account information taken over by some fraudster. The factor, the important part about managing risk is that if fraud were to happen on your accounts, it could very well bury the company or organization. Now, it's a scary thing to think of, but there are ways to reduce or eliminate that risk. And that's also part of the duties in Treasury Management. It's very important for companies to realize that as they're growing. In managing the payments process and receivables process, we tend to see a strong shift away from good old paper, right? The fact is that the majority of B2B payments within the United States occur through check form. Believe it or not, 2018, checks still occur. The checks are still used as the primary method of making payments from one business to another. But as technology, again, continues to develop, we have newer generations that adapt or adopt that technology and implement that in their careers. So it leads us to the preference in payments. So I want to look at this in three different buckets here. Right? Look at the payment formats, the timing, and of course the access to information that comes with those transactions. Millennials are driving a lot of the change that we see today in technology. The demand for different or more efficient versions of making payments, such as going online and making a payment through a website, or using a phone for near field communication at the checkout kiosk in the retail store. Also, the timing. The transactions have to occur basically yesterday in a lot of cases, right? So fast payments, very flexible transaction types or formats, and then the reporting. What millennial takes, makes a transaction and manages a check register today when you think about it. So getting away from the paper registers, getting away from all of that. Everything's done online. And that's the future of transactions. On a business standpoint, if you're the one taking the payment for your service or your product, being able to offer an electronic format or some type of mobile device where these payments can be accepted is the way of the future. And not just for convenience or preference either. It comes down to cost. So if you take a look at this slide, you've got 4 different examples of payment types. Traditionally speaking, checks, and then wires, ACH, and then commercial cards or P cards. Depending on what language you like to use, they're interchangeable for the most part. So this data shows the cost, including all overhead and supplies, to process transactions, whether it's bank fees, etc., the whole picture. So this is it's a little over $7 per check, which is pretty significant when you look at what a wire transfer costs. Now, everyone has their own situation as far as bank fees go with the individual bank that you're working with. Wire fees might be north of the $10.33, and depending on your volume, sometimes that drops. It depends on, again, that relationship. But the industry averages show that paper checks are fairly close to the cost of a wire transfer when you consider all of the expenses. So there's a shift. Go past wires, you see ACH and commercial cards. That's those 2 methods are the preferred ways to make payments today because of the cost, the timing, and the reporting that comes with it, much like what I covered in the prior slide. So commercial cards and ACH, you can include transactional data that is received either by you, if you're collecting that as a receivable, or when it comes time to make a payment, that information is transmitted to whomever you're making a payment to. Ultimately, that speeds up reconcilement and reduces overhead costs for a company to manage that treasury management process internally. Jump to the next slide. We've got a few other solutions that are available to companies that are looking to streamline their day-to-day operational activities as it relates to the cash position of their company. Payments, again, ACHs, wires, commercial card, and then, of course, controlled disbursements. Some of these you may recognize depending on, again, the level of services you have in place today. Lockbox, merchant solutions, all the collections there. Electronic receivables, as was mentioned before, where you can accept payments through, say, your website, be able to present invoices, getting away from paper invoices, the reporting, proper cash forecasting, managing the excess balances that may be sitting in your account, go into a suite, investment services, and of course, utilizing the portals available to you online to manage each one of these pieces. It typically comes under a proprietary name, but essentially it is a commercial online banking website. Even the mobile devices are utilized on a commercial level, where you can make deposits mobilely. You could manage wire transactions even under dual control mobilely. There's a lot of technology enhancements that have happened over, I would say, about the last 10 years in my career and experience. So I mentioned earlier a few times, besides the payables and receivables, we got this thing called fraud. And there's some interesting information here. And it can be scary too. About 75% of all organizations within the United States were subject to fraud at some level, be it account takeover through hack, be it an email virus, or somebody taking and stealing check information and issuing checks on the accounts of the company, or even ACHs or credit cards. So at some level, 75% of organizations in the United States have experienced fraud in the past year, 2017. Checks were the primary target. Again, it's the #1 method of payment from B2B. So it's more than likely going to be, and it has been confirmed, that it is the most used method for conducting fraud on business accounts. You have to take a look at each one of your companies and identify why, or what can I do to prevent this? Why did it happen? Internal controls you have to take a look at. You also have to take a look at what happens between when you put that check in the mail and when it lands at its destination. Do you have control over that? What happens if your data gets out there? What's the exposure to the company? If I were to lose $50,000, $100,000 in a single check and it passes through, what's the recourse? How do I get my money back? Can I get my money back? What's the damage been for the entire United States as far as losses that have been claimed through transaction fraud? $12.7 million. And that number keeps going up too. So the fraud part, I'd like to dive into a little bit more. As we've seen a lot in the news, there's been a number of different ways fraudsters are able to pull money from your accounts. And how do they do it, right? So what do we see? Maybe they got this person that hacks a device or puts a skimmer on a merchant machine that nobody recognizes and was able to pull a bunch of information. Or is it malware? You download a virus to your computer, your network, and it infects all the computers, and now you have a ransomware that's on there, and you can't get access to any of your data. And the data is sold through the dark web. Social engineering, phishing emails. I'm sure we've all seen those. If you look at my email address at wellsfargo.com, someone could easily do a 0 instead of an O at the Wells Fargo and request somebody to make a transfer of some sort that's not authorized. You see that a lot more today, as it seems to be the latest method that fraudsters are using. And of course, just the classic theft. Checks stop being stolen from the office because it's not secured. Could be stolen out of the mail. And you got to ask yourself, how do I prevent this, right? So some of these things you don't have control over. It brings us to something called positive pay, or an ACH fraud filter or block. Again, positive pay is an industry name for the solution, and it's worth looking into if it's not something you have in place today. At the end of the day, your checking accounts are looked at a lot differently than your credit cards are, and the liability factor. Now, a checking account doesn't have, say, I'm going to use a reference as any of the top providers typically have, say, 100,000 to 200,000 approximately in liability coverage in case a fraud were to occur on your card. You usually make a phone call and then you get the credit back on your credit card. It's different when you're talking about a checking account. The bank will do what it can to find what happened through that transaction if it goes through and it's unauthorized, and attempt with any resources that they have to get that money back as that money's traveled through the different accounts wherever it's been posted, etc. There's no guarantee that the money will come back. Traditionally, banks will take the next step and make good on that transaction, but that's if they decide to. I can't say that none of them do or all of them do, but you're at the graces of that bank for making that transaction come back through. So how do you prevent it from happening if you don't have control over it on the back end for a recovery standpoint? So positive pay, you end up sending the bank your check register, and that check register is used as a guideline of what checks are, or cross-reference to what checks are allowed to come through on your account. Anything outside of that gets rejected. ACH fraud filter works pretty much the same way on the electronic side. If a company were to try to debit your account that wasn't on the quote-unquote list of approved debitors, it would get rejected. You have the control, though, to add another entity to an ACH fraud filter list, to contract with a new vendor, They're trying to put money into your account for a payment. If you didn't get ahead of it, they try to attempt, you're notified, and you're given the ability to add that company as an authorized debtor to your account going forward. From there on, the transaction process through fine. You even get controls on how much in dollars they're allowed to pull from your account. We've seen it where some of our clients they allow their payroll company to debit a certain amount because that's what they expect for payroll on a biweekly or weekly basis. And there's times where these payroll companies might accidentally debit too much or double it. And even though the filter is there allowing them to come through, the dollar amount prevented the second transaction from happening. Because even if that were to happen, you got to figure the time that you lose with that money not being in your account and the mobility that you lose to, going back to one of my first examples is, if you had the opportunity to buy some products or pay for a service because you had cash on hand, now you don't because that issue occurred. But you have the ability to control that up front with these types of tools. Another version of fraud through account takeovers or social engineering is the dual control. So how do you prevent a wire or an ACH leaving your account because somebody gets access to someone's credentials? Now, I've seen this come up a lot about 7, 8 years ago when a lot of businesses opted for single authorization because it was a lot easier internally. It's also easier for a fraudster to get hold of your money. So in this example, credit manager receives an email appearing to be from Wells Fargo or any company, and the link opens up and captures all the credentials that were used in recent websites. If you had gone to the Wells Fargo website, if you've gone to any social media website, things like that, the fraudster has now access to that, maybe through key logging and things of that sort. And then they can get access to your commercial online banking website and initiate a wire. So they can go and initiate that wire. If you have single control, that wire is gone. It's one of the hardest things to find or to bring back. That money goes out internationally because as a Treasury Management client to a bank, you typically would have ability, if it's something you chose, to be able to send wires internationally. Now you're at the mercy of the receiving bank to send that money back. It's very difficult and time-consuming to do, if at all possible. Very simple way to get around that is have dual control, 2 sets of eyes, right? So if one individual initiates that transaction, someone else approves it. It even helps with not even talking about mitigating fraud. It helps when you're trying to determine or make sure that you're sending the correct amount out. You're not adding an extra zero. So it's a very useful tool to put in place to mitigate fraud or errors from happening on transactions. Now, I mentioned the commercial online banking website. Coming from Wells Fargo, we have our platform called CEO, Commercial Electronic Office. And a number of these items I mentioned earlier, where you get notifications for an ACH that comes through that's not on the list of approved debitors. You can initiate those payments, going back to the payments part of the presentation. You do all that online through the CEO or a commercial online banking platform. And utilizing a system like this versus a retail level platform that typically comes for free that you could sign up with for any given branch in any company or any bank. It's the security and dual control and the level of service that you would require. Being able to send out ACHs, different from bill pay, wire transfers, international, pulling specialized reports, managing who can see what internally. There's also a factor with fraud on who gets to see what activity. You're not going to give access to your entire team to see the payroll account so that they can see who gets paid what as those checks come through or those ACHs are paid. You want to have control over that. And that's what you find when you work with a commercial online banking platform much like our CEO. Again, a little bit more imagery around some of the points that we've already touched on as far as why a commercial online banking platform could help you. And as far as being able to initiate payments, there is a strategy on why you would want to use an online banking platform such as this and initiate ACHs or wires. The speed of transactions, right? So there's a cost and there's a speed part. So how do you get control over this? You send out a check payment, or you receive a check payment. It could be issued to pay an invoice that you sent out to one of your clients, but they mark it paid today, you don't get it for a week. And you don't have control over when that money comes in. Vice versa, same thing. You mark paid, that check goes out the door, doesn't actually hit your account for days. Right? Old school, slower technology. It's effective, but you don't have the controls that you would have with ACH, same-day ACH, wires, or instant payments. So ACH would clear in 1 day to 2 days, traditionally, depending on the financial institution on the receiving end of that and how fast that they process. Same-day ACH is one of the latest modifications to that ACH payment process, where if the dollar amount fits that criteria and the timing of when that's submitted to the bank for payment, that payment would be effective same day, much like how a wire is. And then it brings the wire transfers. Typically, the difference between these two are going to be the dollar amount of the transaction. Same day ACH, you're capped at around $25,000 per transaction. Wires, of course, your limit is your balance pretty much in your account. Instant payments, we're getting into different versions of payments where you've got multiple banks utilizing a single platform that they all come together and utilize, so payments can be moved from one account to another instantly, even cross-banking. That's the future. Also API, which is the latest in technology for communicating between financial institutions and their clients, their business clients. So as transactions come through, it comes through real time, which is, again, at the forefront of what we expect to be the new norm as the years go on. So again, the holistic approach to a payable strategy might include in the future for a lot of organizations, which is something we're seeing today, is why take all the steps and utilize more time of the employees within your organization to send out wires here, and send out checks here, and send out ACHs, utilize the credit card. And you have a sophisticated ERP software, is there an opportunity to send the bank one batch of instructions? Here's the instructions. Just send out my ACHs, wires, payment, everything in one shot. And that's what we're starting to see now. Streamline processing, integrate with your ERP software. A lot of opportunity to just cut out all the unnecessary steps in today's standards with the technology available, and just transmit an instruction file to a bank and then receive back from the bank the remittance of those transactions and any types of receipts or confirmations that they've been executed. Utilizing something like this is going to cut down overhead in any organization where it makes sense. Not every organization is ready for it, but there will be a time where, as your companies grow in sales and activity, things like this will have to be implemented in order to manage that process internally, unless you're able to hire more individuals. But when you look at the costs, in most, if not, I would say most scenarios, the cost of implementing a technology is going to be cheaper than, or at least less expensive than hiring somebody to do that same job. It's more efficient and it's less expensive. And even if the company is growing, it's not about reducing the individuals that work for the organization. It's reallocating assets and being able to take people that could be on phones or could be adding to the bottom line and keeping them there instead of bringing them into an administrative task, such as managing the payments process and so forth. On the other side, for a more enhanced receivable strategy, is being able to present invoices online and being able to, as a consumer, go to a website, go to a website and click a link to be able to view my invoices and make payments through a credit card or some type of ACH transaction. And that's a growing trend in the treasury management market, where companies now don't want to have to take those phone calls and stop what they're doing so that they can take a credit card payment, or waiting for the check to come in for payment, or even if they were to sign up for a lockbox and pay the fees to process that through a bank. That there could be an easier way. Maybe some of the consumers that are utilizing services are asking for a more electronic version or method of making payments. It's going to help you get the money in faster, whether it's an ACH or wire, and it's going to require a lot less overhead. I mentioned before, API, the application programming interface. This technology has been around for a while, and it's growing and growing as we start to think about that, and also things like blockchain. But API is that instant communication between two systems that might not be related to each other, but that's a bond that's created and the information is transmitted from one system to another. API is the future, or the more current future, and what we're looking at today is the next step in streamlining versus what we've seen for a number of years, where if you were to send a file over to a bank to process payments, whether it's a batch of ACHs or a batch of merchant transactions, that batch had to be put together at the company level and sent over to the bank. That is now moved into a real-time transaction where each payment or each receivable within those files come through as they happen and are processed as fast as possible through that chain. Increases the speed to revenue and also increases the speed to payment. Why would you want to increase the speed to payment? So if you have the ability to manage closely the input of resources that go into making payments and the timing of when that payment hits your account, you can better project where your company is at any given time. It goes back to when we're looking at checks and waiting for them to clear when you send out a payment. Why does that make a difference? Why is it important to streamline that process to have more control over the payment? If you have that ability to project out, you can get the company can be ready and be mobile for future decisions, or to grow or to hire, whichever it is, to pay debts, etc. When you keep more cash available to the company, you also have to borrow less. You rely less on lines of credit or other financial or financing tools, which actually takes us to what we see on the financing trends, which is something that Sid Vaidya is going to go over for everybody. Sid?
Yep. Hi, thanks, Ryan. Wonderful presentation by Ryan so far on treasury management. And I figured I don't want to have too many slides, so I put everything that I wanted to discuss on one slide, talking about the financing side. In the banking world, there's the financing, the lending piece, and then there's the treasury management piece, which is most people refer to the banking piece. On the financing side, a couple of key points that I wanted to bring across to everyone's attention that I guess are my general questions that I get on a day-to-day basis from companies that both me and Ryan talk to. The first question, the first comment, I guess we'll just go down the page here, was when to look for financing. A lot of times, companies, they come to the table a little bit too late, or they're planning out a little too in advance and want to have a conversation about what to do, or where, when is the right time. And when me and Ryan were sitting in front of them, a lot of times we say, how's your working capital cycle looking? Is there cash flow constraints? Are you looking to grow a certain percent? Are you looking to buy certain types of assets? Usually we get end of the year or Q3 into Q4. A lot of companies like to start budgeting for equipment purchasing. And then that's really when the conversations come into play. Usually by January, February, a lot of these companies usually buy the equipment. And a lot of times we're coming across that, they're looking at 3-4 buildings, but they don't know what to do next. And so doing a lot of guidance for that. But, when to look for financing, those are the three really, three hot topics that I'm usually catching prospects, clients, speaking to them about. And moving on to the second point, how to prepare for financing. And this was an interesting one because I get this a lot of times. People think that and I do a lot of LinkedIn posting, and I just recently made a comment about it. The old handshakes to get the banking, the financing work done. Those days are long gone. And now, you have to fit within the bank's box. And Wells Fargo has a box. All the other institutions externally have a box as well. Most of you guys that do the financing aspect of it know how difficult it can be at times. But, that's just the way, the bank's business works, And so some of the key points that I put out there, the first one is, from the management perspective of the company, along with the people that are decision makers, they need to review the business credit profile and history, which that usually entails, how the company's been moving, growth, non-growth, how's the profit and loss statement looking, how the company's been trending in the past. If there's been a year of blip, there needs to be a proper explanation. Those are really key points for on the banking side when we speak about financing. Those are important topics we speak about. The second one was evaluating the personal credit profile, and that usually ties back into the owners, people that will be guaranteeing for the loan, because we don't want to go say, oh, great company, great situation, but then the owner unfortunately had gone bankrupt in the past. That becomes a challenge, or some other issues in the past that haunt them for the future. And so those are things to look at, make sure that those items have been covered. And then the last one is, from the business perspective, have you done your research within the industry, within companies that are within your revenue or maybe net profit size, whatever you want to make those comparables, but check within your marketplace, check within your industry, also what the company's goals are. Those need to be addressed, and those will help figure out that, hey, are we ready to take that step in financing? Should we go out and consider maybe an equity slug, something to do? So those are the items there. And then going on to the third topic, what banks look for to qualify for financing. I've been a credit person in my past. I've been in underwriting, then went into portfolio management, relationship management. I've been a lender, and I'm more on the front facing side, the business development side. But the couple of main topics we look for: the cash flow of the business. We want to make sure that the business can pay off the debt. That's the first thing right off the bat. The second thing is the collateral. All banks, and I've been to a few of them in my past, but Wells Fargo, we want to make sure that we can take first position on the building, on the equipment, on any business assets that the company owns, and that would be the collateral provided to us. And then the third topic goes for when somebody is guaranteeing the loan, the personal guarantee. We want to make sure that the owner or the ownership, there's the experience, the management experience is there, the strength of the individual, how their cash position looks like, how their personal assets look. Are they having a lot of credit card debts? Those are things, the specific things that, that we look at. And then the last thing, which a lot of people don't realize, but banks respect clients that already have a relationship with them. And that means a lot, because sometimes I get a customer saying, hey, I need financing, Sid. And I'm telling them, well, you're not there yet, but why don't you begin by opening a relationship on the treasury management side with Ryan? Why don't you go into our personal wealth team and, maybe build a relationship there. Start building that relationship up, because when the time comes for that financing and when you're ready for it, you can say, hey, guys, at Wells Fargo, I have all of these pieces in the puzzle. Can you guys set this piece up for me? And that means a lot when we go and take it to the approvers here and make sure that that approver knows that there's a relationship in play here. And then the last thing, a lot of times when the bank can't get the financing done, we ask them that, hey, have you went out in the market, spoke with private equity funds, maybe a hedge fund, look for an equity piece, or even go into the private lender side. There's a lot of asset-based lenders. There's a lot of private lenders that, they'll charge you a little bit more, but there's financing out there, and it can get done. I know quite a hefty amount of folks out there in the marketplace because of my job function. I speak with them all the time because I can't, unfortunately, do every transaction at Wells Fargo, so I have to refer them to the right folks externally. So those are just a couple of the items on the financing trends. With Ryan and myself, we work hand in hand. When we go see the customer, we look at both sides of the picture. That's the only way we can understand the full working capital cycle of the client, along with helping them manage the expectations to move ahead and hopefully grow. And that's really where my slide really is. If there's any questions, happy to take them. All right, I'm going to send this back to Ken and Roxanne.
Okay, Sid. We have one question, and the question is, what is the key takeaway from this presentation? Hello?
Ryan, would you like to take that?
Oh, okay. I'm sorry.
I had it on mute. My apologies. So the way I'll answer that is, look, what we do is educate everybody we speak with about what we see in the industry and what trends that we're seeing where businesses are positioning themselves for success. The key thing to take away from this is building efficiencies and being ready and mobile is going to set you up to achieve your growth goals or any type of goals, even if it's maintaining the size of the company or even reducing or leaning out the company for maybe a potential future, M&A transaction, things like that. The efficiencies that you could implement for your organization after you've seen this presentation today could help you and your organization achieve those goals that you're putting in place or already having in place for 2018 and years to come.
Yeah, and to add to Ryan's point on the treasury management side, from my previous experience on the relationship manager role, where I actually have had multiple times fraud happen to my clients, and one of them was over $80,000. Unfortunately, we weren't able to recover almost $30,000 of that. And somebody's job is on the line. Those are preventative measures that if they had positive pay, that another industry jargon, but if they had that service, it would have done them a little bit better. And it was what I consider to be some form of like an insurance almost. So being proactive, similar to what Ryan's saying, it's a big part on the treasury management side.
Okay, there are no other questions today, but I will provide Ryan and Sid's email address when I send the PDF version of the presentation. And if you have any questions, you can follow up with them directly. With that, we are going to close today's webinar. I would like to thank Ryan and Sid for taking the time to present to our group today, and thank all of today's attendees for taking time out of their day to join us. Thank you all again, and we look forward to seeing you at our next webinar.
Thank you.